Now we're off to the balance sheet. All right, balance sheet. Remember we said this one's also called a company's statement of financial position. But in these intro texts, usually balance sheet is preferred because it helps us remember that it has to be balanced by the time we're done with it. So on the balance sheet, we're going to see the company's assets. We're going to see the company's liabilities, and we're going to see the owner's equity. Owner's equity. Okay, and again, as the name of the statement suggests, there should be some equality or some balance in this sheet. Specifically, the assets, assets have to equal the liabilities and the owner's equity. And this is actually, I want to get ahead of ourselves, but this is actually the accounting equation. Simply says that for every transaction, right, especially if there's any assets that are resulted, those assets have to have a claim by either the creditors of the company or the owner of the company. So that's the reasoning behind this equation. And we'll deal more with that accounting equation later. For now, let's go ahead and define assets, liability, and equity. Okay, so assets, these are resources owned or controlled by a company. Controlled by the company. And those resources are expected to bring a future benefit. To bring a future benefit to the company. Okay, let's look at some examples. Some examples, maybe inventory. Inventory is items that we hold and to sell with the express purpose of selling them to our customers. So again, if we were a bookstore, our inventory would be all those books. So these are resources that we control, and we're hoping to sell them in the future. And in the future, they will bring us cash from our customers. Cash is also an asset, something that we own, control, and we can use that cash to buy more inventory, to pay for our employees, to advertise. So cash is also an asset. A new one for accounting classes is AR, which stands for accounts receivable. I think this one and accounts payable are tough for students. Accounts receivable, think of it as customer accounts receivable. These are amounts owed to the company. And so we're taking a company's perspective here. So these are amounts owed to us, to the company, from its customers. Okay, so they haven't yet paid their account, so they owe us. So from the company's standpoint, it's a customer account to be received in the future. It'll be received in the form of cash, usually within 30 days. Rounding it out, supplies. Other assets, equipment, land, buildings. Right, you look around, think of your own personal assets, right? Your house, your land, your equipment, your furniture, your vehicles, right? Same goes for a company. All right, moving on to the L for liabilities. Liabilities, these are amounts owed to outside parties. Okay, we'll list some examples. Most commonly, we think of like loans, right? All those great assets we had, the building, the land, the vehicles, we may have had to take out some loans in order to get those assets. Some examples, loans, mortgages. We're also going to have a new term called AP, which stands for accounts payable. It's the opposite of accounts receivable. Here, instead of expecting to receive cash from a customer, accounts payable mean we are going to have to pay cash to a creditor. So these are amounts owed to creditors. Usually some sort of supplier, right? So if we were that bookstore and we bought books from a publisher and they're going to bill us later, we owe that publisher. We owe our supplier for that inventory that we purchased. Anything that says payable, anytime you hear the word payable, it means an amount to be paid. So it's a liability. Okay, so another common one would be notes payable. But anything payable, just like anything receivable is an asset. So anything payable, interest payable, taxes payable, accounts payable, notes payable, okay? And our last item to define on the balance sheet is owner's equity. This is the owner's claim on company assets. Company assets. Sometimes it's called residual equity, because basically the owner can only have assets that remain after paying off all amounts to creditors. So assets minus liability, whatever's left over is owner's equity. Okay, because those outside creditors, they take priority over the owner or owners of a corporation. If you study business law, we'll go through all bankruptcy law and tell you the order of bankruptcy. But owners are at the very bottom. All right. So we have owner's equity appearing on the balance sheet, liabilities, retained earnings. I think that's good for now. Well, let me mention one more thing under owner's equity. Owner's equity is going to include retained earnings, and any owner investments. We call owner investments, for corporations, we call that common stock. Because if you make an investment in a public company, in exchange, you get common stock, okay? So the owner is entitled to all assets that he put in, all that he invested, and anything the company has been able to retain after paying off all of our creditors, obviously. He has a claim on all of those assets he made, or any assets and income that remain after paying off our creditors. All right, stay tuned for the next one.